Hi, today we're going to talk about the three big risks that you face in your company. One of these risks could bring your company down, could bring your family down, the generational wealth that you are looking to create for you and your family. One of the other risks you've probably heard of. Two of these risks you've probably never heard of. Now, before we get into that, why should you listen to me? Why do you deserve to listen to me? I'm Clint Evans. I've been an early equity participant and participant in two separate nine-figure plus private companies and private company exits. Both of those exited to publicly traded companies called a strategic acquisition. You can read my full bio, business track record in the description below. So for the risks, these three that we're talking about in this video, I'm not talking about economic risk. That's a macro risk. I'm talking about three things that are within your command where you can make decisions, take steps to mitigate those. So the economic cycles, whether we're in an expansion and growth phase, whether we're on a downturn, or at the time of the recording of this video, we're likely headed into a trough. A lot of sources I look at, we're already in a recession. Nothing has been officially declared or published yet because we have an election coming up. That's another macro risk. Here in the US presidential election is coming up. And so a lot of consumers have gotten tight with their money, delayed decisions because of the uncertainty around the election. So I'm not talking about those macro factors. I'm not even talking about industry risk, industry factors, or the fact that do you have a needs-based business versus a wants-based business? One of my mentors, Adam Coffey, who's been a part of $2.4 billion in exits, I get to work with him directly one-on-one. He talks about, hey, if your roof is leaking, you got water leaking on your head, that's not a decision you can delay into the future. You've got to get that fixed right away. So that's a needs-based business. Wants-based business is a company that I had that ended up failing. It was a patio company. It was aspirational product. And people want a cool patio, a full glass enclosed, what we call sunroom. That could be $20,000 up to $75,000. It's easy to delay that decision, delay that purchase, or even not do it indefinitely. So I'm not talking about needs versus wants. That's certainly a risk. And I'm not even talking about project-based. If you work with a lot of home builders or individual homeowners, individual clients on a project basis, or subscription if you got a software company where you got a lot of subscription revenue. The first big risk that we're going to talk about, risk number one, customer concentration. Now you've probably heard about this. It's taught in most every MBA course, Masters of Business Administration, any university and college, and you've probably heard the term thrown around. As I define it, customer concentration is when any one of your customers or clients accounts for 20% or more of your revenue. There's different definitions, 30%, 50%. For me, 20% is about the level. If you've got one client that's more than 20% of your revenue, that's a big risk. If you ever went to exit your company, business buyer is going to look at that, could lower the price that your company trades for. As you're operating the company, obviously that's a risk because if there's a big screw up, one of the members of your team, one of your employees happens to make that customer or client mad, could cancel the contract, put it up for rebid, hire some other company, and immediately 20% of your revenue is gone. That's likely your profit margin as well. So it can be a huge hit. And so when you're dealing with customer concentration, obviously we're looking to mitigate that. So the first thing you can do is, who is that big client? What characteristics? Usually we're talking business to business. It's usually a company that does lots of work with you on an ongoing basis. So what are the characteristics of that company? What kind of revenue? How many employees? What industry? What does that company do? Who are their competitors that you could go out? Hopefully they've got 3, 4, 10 competitors. You can put that list together. Start a marketing campaign. That's your risk mitigation. Reduce your risk by having a communication campaign, a series of communications and marketing messages to those companies. If you can get 1, 2, or 3 of those companies in the next 12 to 18 months, you've greatly reduced your customer concentration risk. Now, turning that into a positive as well, you can have your bookkeeper, we've said, who's your big client? What are their characteristics? You can have your bookkeeper look at who are your top 3, 4, or 5 clients and get an idea. What are the commonalities of those clients? What common characteristics do they have? Build a list of 10, 20, or 50 other clients or companies that have a similar criteria, similar common factors, and start a campaign toward those, because those are your best clients. So if you can get another 5, 10, 20 of those clients, you can really grow your profits. So that covers risk number one, customer concentration. We just covered customer concentration risk number one, which you've probably heard of. Now, this rule, big risk number two, you probably haven't heard of. It's the rule of 130. In a different arena, the financial advisory arena, they've got what's called the rule of 120. Basically, you take 120, subtract your age, and that's the percentage of equities that should be in your portfolio. So if you're 40 years old, obviously 120 minus 40 equals 80 would be 80% equities in your portfolio. Now, where did 120 come from? In the Bible, the book of Genesis talks about a man's years shall be 120. And later on in the Bible, in Psalms, it talks about a man shall live between 70 and 80 years. So perhaps that's where the rule of 120, the origins, foundations of that. I like to look at the foundations of truth in any principle. And so as we apply this to now as a business owner, the rule of 130, you take your age plus the percentage of your net worth, your family's net worth that you have. When I define family as you and your spouse and your children, your nuclear family, if 100% or close to that of your net worth is in your company, obviously you would do 130 minus 100% or minus your age. So if you're 40, you've got 100% of your net worth in your company, you're 40 years old, that equals 140. You're over the rule of 130. You've got too much risk tied up in your company. Time to take some chips off the table. And there's a few ways to do that, which we'll talk about. But basically, I wanted you to have here, and I first heard this from my mentor, Adam Coffey, and it gives you a formulaic, a quantifiable number of risk, which I had never heard of before. I've owned companies most of my career, and I never had a quantifiable way of knowing how much risk is too much risk in my company. If the economy turns down, like we talked about in risk number one, revenue's down 20, 30, 40%, that could collapse my whole family fortune. And so having that number 130 to know how much risk is too much risk, it's very helpful. And I hope you will put this into play in your company. So if you're over the rule of 130, your number, your age plus the percentage of your net worth tied up in your company is over 130. What are some ways to reduce that risk? Obviously, the first number one way, if you're open to it, and if you can find an investor, bring on an equity investor. Sell 10%, 20%, 30, even up to 49%. Sell what's called a minority stake in your company, minority ownership interest. Of course, you'll have to work out the terms and how are decisions made, even though you're still the majority owner. A lot of equity investors don't want to just get railroaded on every single decision. So you have to work out some ways for tiebreakers, and you can talk with your lawyer and your equity investor to get those terms worked out. Perhaps you even are at a stage, if you're at a stage where you're at 4 million in earnings, you could potentially bring in a private equity investor, and they'll most likely want to be a majority owner, 70, 80% equity ownership. That's another great way to take some chips off the table, but few companies achieve that 4 million in earnings. So it's likely you're talking about an equity investor, a minority stake. Another way you can do it is that cash flow, things that the cash that you had been keeping in the company bank accounts or bank account or bank accounts, you can start moving some of that money into real estate. Say your spouse likes real estate, wants to be a real estate professional. That's a lower risk compared to other businesses. Very high success rate. If you have rental properties, obviously there's also a lot of tremendous tax benefits. If your spouse is a real estate professional and you've got rental properties, you've got even more tax benefits that can even offset some of the taxes in your current company, potentially. Some of those losses. Talk with your tax professional, your tax strategist. Hopefully that's your CPA, but may not be. And so a second place, obviously you could put some of those, get some of your chips off the table, get some of the money out of the company bank account, is going into publicly traded assets. That's a whole separate video because there's a lot of strategies on how to do it. Finding a trusted financial advisor, kind of like finding a great realtor, finding a great mortgage broker, finding a great business transaction lawyer, finding a great CPA. It's a similar process to do all, but the one thing you want to look for is somebody that's a top 10% performer, top 5% performer. Again, that would be a whole separate video, but that's another way you can do it. Take some of your chips off the table, get some of that risk out of your company and into, by bringing in an equity investor to convert some of your equity into cash, potentially going into real estate or publicly traded assets. So now we move into big risk number 3, illiquid. Your company is illiquid. As we talked about in the previous segment, if you wanted to find an equity investor, that can be difficult. If you want to find a business buyer to fully take your chips off the table, maybe you're tired of your current company, you're tired of that industry, you want a new challenge, you want to move into something else, or you're close to retirement age, you want to retire and travel with your spouse, your 60s, your 70s, you're in your 80s, or early retirement. All of those reasons can be valid. The thing to do and to plan for is your company is illiquid. You probably don't know this. 89% of all listed businesses, these are businesses that actively list for sale. They're published, promoted on the web by our business. Our business is for sale. You've hung the for sale sign out. 89% still don't sell. And though almost all of those are listed with a business broker that buys and sells companies for a living, and still only 11% of published and promoted companies for sale actually change hands. So what can you do to reduce this risk? Get yourself into that 11% category that actually sells. Well, first, you want to find, obviously, a top-notch business broker, like we talked about in the previous segment. Find that top 10% business brokers in your area. Or you could potentially go with a nationwide business broker, but usually a local broker is the way to go. And ask them how many transactions they completed in the last 12 months. Trailing 12 months is what that's called. How many transactions have they completed in the last 5 years? And in the last 12 months, if they've closed between 5 and 10 transactions, that's in the top 10% of business brokers. That's a good rule of thumb. And then, of course, interview them, see if they're a good personality fit for you. They're going to represent your company culture, and get you that top price. Are they a good negotiator? Are they good with confrontation? Not good with confrontation. Do you get an idea that they have a good work ethic? Now, as you're building up to that point, you know now that your company's illiquid. You probably knew that before, but you probably didn't know that only 11% of companies sell. So what are the things you can mitigate? We're going to go through the five big ones. The first one is, are you a cult of personality in your company? So is your company driven by you, the owner? Meaning, if you get taken out of the company, you sell, and another owner comes in, do you have relationships with your top clients? Maybe going back to risk number 1, you've got relationships with your top 4 or 5 clients that account for 50% of your revenue, and that's going to be hard to hand off that relationship. Do you not have things documented well enough in your company that is based on your knowledge and your skill set, and you're not looking for a 2 or 3 year transition period to train the new buyer of your business? That's a big, big risk. Probably the first risk, the number one risk that a business buyer at this point in the phase of your company where you're looking to sell, that's the biggest thing they're going to look at. Can the company continue on without you, the owner? So is it personal, very based on you and your personality, or is it an ongoing company? You've got 4 or 5 employees, 10 employees or more, and you've got established, documented systems in place. Second big reason a lot of company transactions fall apart, making companies very illiquid, is price. You got that price that you, the owner, want to price up here, but the buyers in the marketplace is willing to pay a price down here. And obviously that doesn't work for both parties. And a lot of times, as an owner, you've got an idea that your company's worth here, and it's not based on data, it's based on hearsay. So I would advise, when you're talking with your business broker, he's got access or she's got access to databases that can tell you what companies in your industry have traded hands for, what multiple of EBITDA or seller's earnings have they traded for in the last year, in the last 5 years. You can get a good idea of where that multiple is, so you can get a good idea of the value of your company. Your broker should be able to help you with that. And so if your company's worth $1 million, but you think and you want your numbers $2 million, you've got some work to do to close that gap. You can either accept that the $1 million is where it's going to trade hands for and get out now and move into some other investments with that $1 million, or you can put a growth plan into place to bridge that gap to now get your company up to 2 million. And if you're going to bridge that gap, stay in your company another year or two or three. Again, you should be able to talk with your broker. He can tell you 2 or 3 areas in your business, your pricing, your operating leverage, your team and your culture, where if you put some specific action steps into play, you can close that gap, and what amount of earnings it's going to take to get you to that $2 million valuation you're looking for. Third reason, terms. A lot of companies don't trade hands because of terms. The buyer wants terms up here. You, the seller, want terms down here. Maybe the buyer wants you to take a 50% or 100% owner finance note, and you're unwilling to do that. You want some cash off the table. Or maybe they want to do a 10% down payment and a 90% owner finance note. I've seen a lot of that happen where you just can't get the terms right, because as a seller, usually you want 80-90% of your company value paid to you in cash, and then maybe a small note of 10 or 20% seller finance note. Gets into the fourth reason, people. Do you have both enough people and people with the work ethic, the attitude, the mindset that the new buyer is going to feel comfortable that this company can continue forward, continue to grow 10%, 20%, 30% or more per year, that quote compound annual growth rate? Do you have the people in the team already where the business buyer is not going to have to go out and do a heavy amount of recruiting, heavy amount of investment, do that whole process? So that's a big piece, your people. And if you get your broker or some HR person to evaluate your team and say, hey, we might need to make an upgrade in this role or an upgrade in that role. You've now got a plan to do that. And hopefully you've got 12, 18, 24 months before you're actually looking to close a transaction on your company. And you should start this process 12 to 24 months before you'd like to sell, to prepare your business for sale. The fifth and final reason we're going to go through today is process. That has to do with your operations. How is your operations process? Is it documented in writing? Are your people very familiar with your process? How do you greet customers? What steps do you take when you're at their house, if you're doing services on their house? What steps do you take when they're an incoming client? If you say you do accounting or you're a financial advisor, what steps do you take? What steps do your people take? Your admin person, that first line of contact with your prospect that's looking to become a client. What are the steps to take? How do they answer the phone? What kind of voice? Are they cheery voice or not? All of those things, do you have them documented, easy for the business buyer to see in your process? Again, if you get those things better documented before the buyer comes in, that reduces the risks in your company, and the buyer can see that the risk is reduced. They'll be more confident going through with the transaction, and they'll be more confident paying a higher price and closing. Now for bonus risk number 4, your succession plan / star employee. So you've probably heard of succession plan, but most business owners I talk to and work with, if I'm working with them on their growth or their preparation to exit, they don't have a succession plan in place. Do you have a succession plan? You've heard the term. Do you have a plan in place? Is it written out? Have you had that conversation with the employee or your family member, your child, your cousin, even your grandchild that's going to succeed you, take over and run the company when you're ready to retire in 1 year, 2 years, 3 years, 5 years from now? So first off, is there somebody, if you don't yet have that person identified, is there somebody in your company? Maybe there's 1, 2, 3 people in your company that you feel like have good leadership skills, they have ambition, they've taken initiative on some projects, taken on some work outside of their narrowly defined role, and you feel like they could grow into that leadership role, be your successor. Give them 1 or 2 tasks intentionally that are outside of their job description. See how they take it. Do they approach it with a cheerful attitude, with a positive attitude? Are they willing to learn? They say, oh, I can do this, that can-do attitude. Are they willing to do that? Do they take that and have the work ethic to do that? If they do, that's a positive sign. Then you might start to have that conversation. Hey, I'm thinking about having you take over the company after I'm ready to retire in 2 years, 3 years, whatever that number is for you. And get their response, have that conversation. If they say yes, and you've narrowed down to 1 person that you'd like to be your successor, then I definitely recommend have them start doing some leadership training. Maybe that's once a quarter, once every 6 months, depending on where you assess their leadership skills. How do they deal with the other people in the company? Start giving them opportunities to deal with other employees in your company. Start giving them opportunities to deal with client complaints. A client calls in with a complaint, have them do that difficult work, those difficult conversations that most people don't have any training for, most people are uncomfortable doing, and most people haven't got the practice. Get them some practice in those difficult conversations. See if they can turn that client frown upside down, for lack of a better term. And so if they can do that, if they take to that, you've identified your successor. Now, what if you go through your company roster and you say, I don't have anybody that I'm comfortable being my successor? So then you can look outside of your company. Is that a family member? Again, child, grandchild, cousin, niece, nephew. If you don't, then again, you can start recruiting. Get with an HR person, get with a recruiter, get with somebody at Indeed.com or ZipRecruiter, and here's what I'm looking for. Maybe you go to an executive recruiter. I'm looking for somebody to succeed me. Here's the basic parameters: salary, probably anywhere from $100,000, $150,000, $200,000 a year, and have an equity piece, an equity kicker that they can earn if certain performance metrics, revenue and profitability, and probably employee satisfaction are met, are some good benchmarks to allow them to have those equity granting if they meet or exceed those performance levels that you agree on. And then finally, that's the third point in the succession plan star employee piece here is, how do you keep that person? You've identified your successor, whether they're inside your company now, a family member or non-family member inside your company, or you've recruited from outside your company. You've done all that work. You've been grooming this person. You've been coaching them, mentoring them, give them opportunities to have those difficult conversations, to grow in their leadership. Then how do you keep them? You want to continue to challenge them, give them additional challenges and additional responsibilities. People love that. To give them the recognition, recognize when they're doing things well. As a coach, you're correcting them when they're not doing things that you'd like them, the way you'd like them to do it, and then coach them and recognize them when they do things well, when there are big accomplishments, when there are big wins, celebrate those wins. And finally, of course, there's the profit share, the financial incentive to keep them, the profit share or the equity percentage they can earn when they meet certain milestones, when they get those wins. That's a good way to keep that when they know they've got advancement, they know they've got a financial incentive as well to stay here versus opportunities out there. I hope you will put this video to use. You will reduce those risks in your company. As a quick recap, risk number 1, customer concentration. Risk number 2, rule of 130. Again, you'll remember your age plus the percentage of your family's net worth that is tied up in your company. If that's over 130, that's too high of a level of risk. You want to reduce your risk, take some chips off the table. Risk number 3 is your company's illiquid, and those 5 big risks that keep companies from selling. And then the bonus risk, the succession plan. Most companies don't have one, so that's a risk. And who's that star employee? Start identifying and grooming that person now. I hope you'll put these to work in your company to reduce your risks so that your company will run smoother while you're operating it, and your company will be able to sell when you're ready to sell. Have a fantastic rest of your day.